Hello everyone. It seems at long last that life is slowly returning to some form of normality after 18 months of the pandemic. I'm now back in the office most of the week. I've taken my first business trips and I've met with numerous ISDA members face to face. It's reminded me how important connections and interactions like these are. While we must remain cautious and alert, I'm optimistic that we'll be in a much better spot in 2022. But despite the pandemic, our agenda has not slowed down, and in fact, we've been able to deliver on a huge volume of critical solutions, products, and policy responses. These include benchmark fallbacks, our first ever natively digital definitions, a new digital documentation platform, Phase 5 implementation of the initial margin rules, and an update to the ISDA SIM. On top of this, we've extended our focus to ESG with the aim of developing standards and legal documentation and best practices for carbon and other ESG-related derivatives. We've also established a new working group to consider the legal and documentation issues relating to crypto derivatives. This is exciting new work, and I'm looking forward to engaging with the crypto community as we unpack the aspects of this market. Now, in my remarks today, I'd like to focus on three issues: ESG, benchmark reform and the impending death of LIBOR, and our digital and crypto initiatives. I'll start with the important work of a transition to a green economy. Financial markets play a critical role by mobilizing an estimated $110 trillion in capital needed by 2050 to invest in renewable energy and infrastructure, as well as helping companies manage their risk. Broadly speaking, there are four key drivers. First is the shocking and catastrophic weather events across the globe that are forcing us to reconsider and address the impact and risk of climate change. The second is the commitment by governments to reduce emissions. Even ahead of the forthcoming COP26 climate summit, more than 130 jurisdictions have now pledged to reduce carbon emissions to a net zero by 2050. Third, voluntary commitments by companies to cut their own emissions and meet a variety of sustainability and development goals. And fourth, the strong interest by asset managers, pension schemes, and others to invest in green assets. Together, this has driven rapid growth in ESG-related financing, investment, and hedges. But as volumes continue to climb, industry standards and best practices are needed to keep pace at the current market functions to ensure it functions safely and efficiently. Now, this is where ISDA is putting its focus. A critical component of a successful transition to a green economy will be the development of transparent and resilient carbon market. Establishing a realistic price on carbon will spur development of climate-related financial products and provide more transparent pricing of climate-related risks. Both are vitally important to driving investments towards a new low-carbon technologies and infrastructures. Regulated carbon trading systems are already up and running in several jurisdictions, and work is underway to complement these by developing a framework for scalable voluntary carbon trading market. Now, there have been some questions raised about the need for carbon trading, and as a suggestion, it's a way of avoiding behavioral change by simply buying up credits. We believe it will be very difficult to achieve transformational change without the voluntary market, but we recognize the need for carbon credits to be very clearly and strictly defined. This will ensure that the market scales safely and efficiently without the risk of greenwashing. The Task Force on Scaling Voluntary Carbon Markets was established last year, and they've made rapid progress in providing the necessary governance to ensure that we have a transparent and robust standards for the verification of carbon credits. ISDA has contributed actively to the work of the task force by promoting the importance of a solid legal foundation for carbon credits, and will continue to be involved here. We have developed a paper to address certain legal and documentation issues that need to be tackled before contractual terms can be drafted, and we are now working to support the development of robust documentation templates. This brings me to ISDA's role in promoting legal certainty, standards, and best practices, which will be critical to supporting the transition to a green economy. We have already published documentation templates to support the trading of emissions and certain types of environmental derivatives. These include US, UK, and EU emissions trading annexes and a US renewable energy certificate annex. As green financing grows, we'll continue to work with our members to identify areas where standard terms, documents, and definitions are required. Robust standards are also critical in any nascent market. And after the past 2 years, we have seen the emergence of a new breed of sustainability-linked derivatives that link cash flows to certain market sustainability objectives, using key performance indicators or KPIs to track compliance. ISDA has been closely following this evolution of this market, but we recognize it will be impossible to scale without these standards. And to that end, we've developed a set of guidelines to promote the use of KPIs that are measurable, verifiable, and transparent. We are also acutely aware of the need to ensure green instruments are treated appropriately in the regulatory and accounting frameworks, and we've published papers on both topics, one recommending solutions to issues associated with the U.S. accounting treatment of ESG transactions, and the other analyzing the impact of carbon credits under FRTB. Reaching net zero is going to require every sector, every company, and every individual to play its part. That's why ISDA is committed to supporting the transition across multiple fronts. You can count on us to continue this important work in the years and decades to come. Climate change is a topic that will dominate our markets for some time, but there's another, more immediate issues that we also must deal with as well. Benchmarks are arguably the most pressing, and we're now just over 2 months away from the end of 2021, the point at which 30 LIBOR settings will either cease or become non-representative. This deadline has been looming on the horizon for the past 4 years, and a colossal amount of work has gone into preparing for a smooth transition to alternative reference rates. While 5 US dollar LIBOR settings will continue to be published until mid-2023, regulators have made it absolutely clear that these should not be used after the end of this year, except in limited circumstances. So there really is little time left until the market participants need to move away from LIBOR altogether. In recent months, we have seen a marked increase in trading on alternative reference rates as market participants have stepped up their transition efforts. In particular, trading in SOFR and TONA rose significantly after RFR first strategies were adopted in the US and Japan. In both cases, the requirement to switch quoting conventions proved to be critical catalysts in leading to 69% growth in SOFR and 112% growth in TONA in August, just the first month after strategies were implemented. Of course, there's still a way to go, but the rise in RFR trading volumes is still a positive sign that market participants recognize the need to switch to alternative reference rates for all new trades. Progress has also been made in transitioning legacy positions ahead of the year end, but again, there's further work to be done. In December, major clearinghouses will convert all existing cleared swaps linked to Euro, Sterling, Swiss franc, and Yen LIBOR to RFR overnight index swaps. At a stroke, this will eliminate a large volume of legacy LIBOR exposures. For non-cleared derivatives that continue to reference LIBOR at the start of 2022, we have a safety net of the ISDA fallback protocol. So far, more than 14,500 entities across 90 jurisdictions have adhered to this protocol, which incorporates robust fallbacks into existing non-cleared derivatives. This means legacy LIBOR trades will automatically switch to the adjusted RFR following the cessation or non-representativeness. This is dramatically reducing the systemic risk posed by LIBOR's demands. The ISDA protocol remains open for adherence, and there's still time to sign up for those who have yet to incorporate these critical fallbacks. ISDA is now developing a second set of fallbacks for other LIBORs in New Zealand, India, Malaysia, Norway, and the Philippines. 2 of those rates in India and the Philippines use US dollar LIBOR as an important input. So it's important that robust fallbacks are in place before the remaining 5 US dollar LIBOR settings either cease or are deemed non-representative in mid-2023. We're making good progress, and we plan to publish that new protocol by the end of this year. All of this gives me cause for optimism that we are headed for a smooth transition away from LIBOR. Nonetheless, we have to maintain the momentum as we move closer to the end 2021 deadline, ensuring that RFR trading continues its upward trajectory and the appropriate arrangements are in place for legacy positions. I'd like to finish by briefly touching on our digital initiatives. During the course of this year, we've advanced further towards our ambition of a fully digital derivative trade lifecycle. Publication of the 2021 ISDA interest rate definitions in June marked a major milestone on that journey. This is ISDA's first natively digital definitional booklet underpinned by My Library, our brand new digital documentation platform. Market participants are now starting to adopt the 2021 definitions, but this is only the beginning of the digital revolution. My Library allows us to revise documents far more efficiently than in the past, removing the need for endless supplements, revisions, and paper trails. As we add more documents to the platform in the coming months and years ahead, we will pave the way towards greater automation and efficiency in the management of legal documentation. Now, as I mentioned earlier, we are also exploring the fast-growing crypto derivatives market. We very much intend to stay in our lane here, so our focus will be on the legal documentation and capital issues associated with crypto assets. As an example, we're currently looking at questions that would need to be addressed before market standard templates and definitions for crypto derivatives can be developed, including product scope, valuation and settlement, and the implications of adjustment and modification events. Expect to hear more about this before the end of the year. As I noted at the start of these remarks, we are slowly emerging from the COVID crisis, and we're facing up to the challenges of the climate crisis. It's a time for both hope and anxiety. But ISDA is committed to helping the industry meet these challenges head-on by developing mutualized solutions, legal documents, and best practice standards, and by setting the foundations for a digital future. We very much hope you'll join us on that journey. I'd like to finish by thanking our sponsors, our speakers, and our delegates for supporting these regional events. I'm looking forward to hearing the insights of our keynotes and our panelists. I hope you find these sessions engaging and constructive. Thank you very much for joining us.